Awesome. Good afternoon, everyone. I'm really pleased to be here all the way from London, England, and I'm looking forward to moderating this panel with an esteemed set of panelists, talking about some of the challenges and opportunities that face institutions as they move from the traditional world into crypto and the whole digital asset space and beyond. My name is Simon Barnby. I'm Chief Marketing Officer for Archax. We are an FCA-regulated digital asset exchange, broker and custodian, a real focus on institutions, so it's a very sort of relevant topic to cover today, particularly from me. But let me kick things off by asking the panel to introduce themselves, maybe starting with you, Chuck.
Sure. My name is Chuck Lugay. I'm head of execution services at sFox. 20 plus years in traditional finance, so this is very appropriate for me to participate in, given that I just made the transition at the beginning of the show.
Cool. Steve.
So I'm Steve McConell. I'm the head of sales for BSO Networks. We're a global network service provider. I've been in the telecom industry for 20 years, and I'm excited to be on this panel with you, Simon.
Great. Thank you, Steve. And Ilya.
I'm Ilya Gorelik. I was just here a few minutes ago. At the moment, I'm running the Product Innovation Center at EPAM, and prior I was the CEO founder of Deltix, software company for quantitative trading and research.
And finally, Brad.
I'm Brad Vopni. I came all the way from downtown Manhattan. I work at Hudson River Trading as head of digital assets. Been there for 4.5 years, responsible for our crypto trading initiatives. And before that, did a bunch of stuff on the exchange side. Been in electronic trading for 20 years as well. Ireland, INET, NASDAQ, and then some ETF stuff as well.
Great, thank you all. So to kick things off, I wanted to give a little bit of context maybe, because obviously cryptocurrencies are hugely important, but we're here to talk about the digital assets in their broadest sense. So we're thinking about cryptocurrencies like Bitcoin, ETH and the like, but also other assets, for example, stable coins, for example, tokenized assets. I mean, there are many examples now of people taking funds, real estate portfolios, equity and debt, but also art and everything else, and creating tokenized versions or records of ownership of those things. So we kind of want to talk about digital assets in their broadest sense. But the focus, I guess, to start with our, the first question to the panel. I mean, so if you're a traditional institution and you're looking at the digital asset space, maybe crypto initially, what are the kind of challenges that you face? What are the sort of challenges you need to think about? What are the sort of the issues that you're going to have to sort of think about to move as an institutional player into the crypto space? And maybe start with you, Chuck, please.
Yeah, sure. I think that there are a number of nuanced differences going from traditional finance into the digital space. Things like 24 hours a day, 7 days a week trading. Things like back office, staffing 24/7 around the world. So all of these things have to be taken into account in order to get into the business successfully and be able to run a business profitably. And the regulatory environment is something that you really have to adjust to, because coming from traditional finance, we all know the kind of regulatory environment that we all lived in since 2008. And that's something that's evolving as we speak within the space.
I think that's really important. I think regulation we'll come back to later on in the panel and focus on it a bit more detail. But Steve, what's your view? The challenges facing institutions, maybe from a technology perspective.
Yeah. So the challenges that our customers are coming to us with are primarily bridging the gap from the physical infrastructure that's in place for traditional markets, moving into the virtual world. So how do they connect to the cloud? How do they effectively participate in this new market? So that's been a huge challenge for our customers. Some things that we touched on, before this, the panel here, best execution and order flow, et cetera. All those things are challenges that require new expertise in connecting to the virtual space.
Great. No, thank you for that. And again, the whole best X area, I think we'll come back to shortly and delve into a little more deeply. I want to jump to you though, Brad, next, and just thinking about maybe some of the challenges that institutions face, given the recent market conditions over the last week or so. I mean, what are the things you worry about or would worry about coming into the space, given what's been happening? So.
I think the events of the last week highlight sort of one of the fundamental issues. And so regulatory, or sort of lack of regulatory clarity aside, ultimately I think sort of two things need to happen for sort of true institutional adoption. One is, they're somewhat connected. I think one is the ability for institutions to get access to this marketplace through familiar wrappers, through familiar counterparties, through familiar service providers. And sort of that pivots to what really matters is it's kind of a legal problem and it's a counterparty risk problem, right? And so ultimately, it's really hard to take customer assets, deploy them on an exchange that's jurisdictionally based in the Seychelles and feel like you have great legal recourse in the event that something happens to like your customer assets there. And that's a really hard thing to solve. And it's not, I both appreciate why many of the platforms and exchanges have sort of opened up and either incorporated or opened up businesses in areas like that because there has been more regulatory clarity or because there's less regulatory risk. But that obviously sort of like means that it's really hard for any sort of true institution, outside of those of us on a proprietary basis, to really sort of delve in deep without sort of traditional service providers being involved and being able to ultimately have legal recourse in the event that there are, in which we've seen, there are going to be issues.
Sure. And Ilya, in your talk earlier, you were kind of running through some of the sort of tools and services that you provide. I mean, what's your take on the things institutions need to think about?
Right, irony is that I actually don't believe that technology and even best execution is a real problem, at least from what we hear from our clients. The biggest problem is actually custody and things associated with deposits of funds and management of them. We have clients who actually been hacked. Like, despite all the stories about 21st century securities and this kind of asset supposed to be the safe one, we literally had a client who was unfortunately completely wiped out by internal hacking. So they didn't even have a chance to prevent themselves from being managed to be basically robbed from inside. So these digital assets are definitely incredibly promising, but yet it is definitely very kind of uncertain. So I would say that when we talk about technology, market access is all of course important, but basic stuff. What do you do with assets and how do you deal with them and deposit them and maintain them? That I think is probably one of the biggest challenges, at least how I feel.
Sure. Anyone else, anything to add before we move on?
So just to Brad's point earlier, institutional adoption. So how do we get more participants into the digital space? From our perspective as a network service provider, providing a physical infrastructure, a known latency between your trading endpoints enables our customers to create trading strategies and products to deliver to the market, which breeds confidence and eventually brings more participants into this space. And I think that's where things are going and definitely need to go in the future.
Sure. I mean, so I want to focus now a bit on BEX execution. I mean, I know, Chuck, you spoke about it earlier today, this morning, but maybe I'll kick off with you. So BEX execution, why is it so important and how do you get it in a crypto world?
That's the key question right there, right? How do you get it in the crypto world? It's a challenge because when you think about best execution, I had spoken to this point earlier, there's a number of things you have to take into account. Price obviously is tantamount, but there's also slippage, fill rates, counterparty risk. That's another piece that Brad had mentioned earlier, and that's come to light very clearly as of late, right? But coming from a traditional finance world and trading in markets where I had constantly, and my peers in the space had constantly complained about the concept of fragmentation, that's magnified 10x on the digital asset space. So that in and of itself creates a big problem, because when you're talking about best X, you want to have access to the best prices. You want to have access to the most reliable counterparties. It's impossible to do that, though, when you're talking about 600 different exchanges and market makers. So today, the best way to do it, one of the few ways to do it, is to connect to as many people as possible, and to aggregate as much liquidity as possible. And in some way, shape, or form, you're almost creating a quasi-national best bid and offer, a quasi-central limit order book based on your connections. So, I think those are the solutions that we have in place right now to address best execution at this point.
And maybe there are lessons that have been learned in the traditional world that we can leverage in this new world. I mean, Brad, what's your take on why best X is important and how best to go about getting it?
It feels weird to answer the question why best X is important, but I'll give it a whirl. I mean, it's if you're representing any client orders, right? Like, you want to give them the best possible outcome for what their investment or trading thesis is. But to Chuck's point, that outcome isn't solely based on price. It is based on a number of other factors and variables that influence how you execute, how you access the market. And it is a market where like my BTC or someone's BTC at Coinbase is not fungible with the BTC at Kraken, right? And so there is no CCP that ultimately allows me to ensure that, like, I have enough collateral already parked at that particular exchange, if that is indeed where I'm going, in order to source that liquidity. And so it's expensive, so it's capital intensive, and I think all that being said, if you go and you look at someone like eToro's website, there is like a best X policy on that for your traditional brokers that are in their space that are offering the ability to go and access crypto. And so I think what we'd like to see, and I think what firms have started to galvanize around are kind of principles around best execution and advertising those and being sort of transparent around how they go about offering best X to their clients. What are the variables that they do use? And to some extent, like, how many desks do they use and how many exchanges do they use? Because ultimately you will find on a number of times that a number of OTC players will have a better price. They're axed on one side or another of a particular coin. And so having access to significant amounts of liquidity, having sufficient capital to deploy it on those venues in order to be able to access that liquidity are things that are available to the marketplace today. But it does require infrastructure, it requires capital management, it requires risk monitoring, and it's a little bit more difficult than your standard sort of U.S. equity-based market. So it's some combination of the U.S. equity, sort of the pink and bullies, with sort of how U.S. equities works today. What I'm hopeful is that we see a principles-based approach, in so much that there does become some regulatory clarity around this, just a principles-based approach instead of being as prescriptive as NMS necessarily calls for in terms of like how one needs to execute in the market versus what are the things that a firm needs to think about when executing on behalf of their clients in the market.
Yeah, I mean, and Chuck, you said earlier, 600 plus exchanges, you can't connect to all of them. So then you get into the situation where you're having to judge, well, how do you measure quality of an exchange? And they all have different, pricing models, trading models and stuff. I mean, Ilya, what, from your side, your thoughts on, how you navigate all of that?
Right. My thoughts are, again, kind of based upon practitioner with software guys who build technology. I'm not talking about best execution. I prefer to good enough execution. So to me, the conversation,
it's better execution we decided.
Right. To me, it's not about best, because best by definition is only one, and you can go to infinity and find perfect solution would take you forever, and you will never find it. It's a good enough execution, being pragmatic and being reasonable, and thinking about the fact that a lot of geography, all the trading venues, is not in U.S. So clearly, we would love to have Reg NMS, right, which happened on equities, and it changed the game, right, because the prices now insured by kind of a policy. No, clearly it's not happening here, and it's all global. And so dreaming about theoretical price, a theoretical execution, considering the fact that you're running the risk of being sort of hacked or whatever. So good enough execution is the goal, and from my perspective, that should be the target. And pragmatic, being constraint-driven, with a clear message of management of risk, and all the technology kind of things. So that's what I feel is important.
Sure.
And that's the trick, though, right? Because you're looking at if you're looking at very conservative institutions like a Raymond James or a Charles Schwab or something like that, you can reach their clients. I think they'd be uncomfortable with the concept of good enough execution, right? So they're going to try to replicate an environment that they feel comfortable in order for them to embrace.
But they'll fool themselves. They'll think they have the best execution while they're not, and it's just complete. They would be reporting the checkboxes to the bureaucracy that they've got best execution. In reality, it will be not even good enough.
Right.
So if they try to do good enough execution, they'll be probably in a better shape.
Right. But that actually breeds a competitive marketplace.
Right.
So if my good enough execution is better than your good enough execution.
Here we are.
Right.
Run benchmarks.
So that's actually what our customers are striving for, is finding a better execution as opposed to best execution. And in this global space, how do you go about doing that? Right, so we've built a global infrastructure over the past 15 years. Crypto connectivity happens to overlay onto our network very nicely. We have known latency between all of the key crypto locations, and our customers are connecting them together to provide the best execution that they can provide to their customers. So it's an evolving space, and we're excited to be part of that.
It's a moving target.
Yeah, I mean, let's maybe focus on the technology a bit now too. I mean,
It's amazing.
Yeah, but how has it changed? Obviously it is becoming more and more institutional grade, but, compare what it was like 5 years ago to what it's like today. I mean, how do you see things, Brad?
5 years ago, we sort of described trading as connecting.
Buy low, sell high.
Trading, on the crypto marketplace as trading on glorified websites, right? And it's sort of what it felt like to some extent, and that the interface by which you deployed and accessed and moved sort of your treasury functions in crypto was all through some website, through some single login, and you had to be mindful of who has access and who has the ability to sort of move crypto around or to access the GUI, because once you're in, anyone can sort of move stuff around. That part hasn't changed, unfortunately, but I think the tech stack behind it has, and I think that's been really useful. I think what is interesting is they have the platforms have very different technology requirements than sort of your traditional equities futures exchanges, right? And so they're not intermediated by brokers. They are designed for you and I to typically access via our phone. And so they need to have the ability to deal with millions of concurrent users. They need to get access for people via the web. They are the clearinghouse, the custodian, the broker, and ideally not, but sometimes even the dealer in the space as well. So the technology stack is very different. I think what we've seen over the last few years is just the appreciation that it's relatively easy to spin up an exchange. It's really hard to scale that exchange, and one of the reasons is because they are sort of the broker in that space, and they are wearing the risk in the event, especially on the future side of the perps, of any liquidations. And so it's really their risk engine, their risk models that have to work incredibly well in order to be able to handle the kind of throughput and sort of resting orders, outstanding orders. They don't all do it great. It's been certainly a work in progress, but I think we've seen tremendous strides in these glorified websites, turning into kind of bona fide exchanges using cloud-based architecture, which again, most of us, at least on the proprietary or traditional trading side, are used to. We're starting to see a pivot though, where a cross-connect into our infrastructure that we have deployed around the globe for equities, options, futures, and other asset classes is now becoming useful. And even the way we approach the market is trying to be thoughtful of how the crypto exchanges are moving forward. What should we be doing in the cloud, because that's what they're doing as well? And where does that? Where do we sort of draw the line from a security, from a risk perspective in terms of how do we adopt what? How the exchanges are sort of deploying their architecture and their infrastructure that still fits our needs, but fits into theirs as well. Obviously, if we were a native crypto trading firm, we would just deploy everything on the cloud. But we have the pros and cons of having infrastructure that we've built out over the last sort of 15 to 20 years that we do get to leverage, but it's not perfect for crypto trading.
Sure. And Steve, I mean, I'd be interested to hear from you because how has the model changed? From in terms of the way applications are hosted, the way comms networks operate. I mean, I know you have some views on how things are going to change going forwards too. So,
yeah, great question. So, being in the industry for 20 years, I remember when T1 circuits were a lot of capacity, and the traditional infrastructure has grown from T1s to it's a 100 gig circuit now. It's astronomical, the changes and the growth. And if you don't have RF infrastructure in your traditional trading platform, you're well behind the curve. So in the crypto space, that hyper latency has not really mattered to this point. Things were in the cloud. It was easy to spin up things in the cloud. Availability was good, but performance lacked, as Brad pointed out. You can build an exchange in the cloud, but scaling that is very difficult. Managing the infrastructure to support all the requirements, all the users trying to access your platform is very difficult in today's day and age. If you open an app on your phone and it's not there in 3 seconds, you move to the next one, right? So that's the challenge that these platforms are addressing. What we're finding is that the purely cloud-based folks are moving to a hybrid model where they need some physical infrastructure in their network to support that growth, to have a known entity supporting their applications in their platform.
And TradFi is changing as well, right? In a similar way, it's kind of the model is changing. And I want to move on to regulation, but I think one thing just to mention on technology is, this new technology, blockchain, tokenization, can bring all sorts of benefits, particularly in post-trade, to the traditional financial markets world too. So, ultimately, all capital markets are going to become tokenized and sit on chain because it's a much more efficient way, particularly for post-trade. Really exciting. But let's touch on regulation. I mean, good, bad. What is appropriate regulation? It's complicated because crypto markets tend to be global, and yet regulators aren't. I mean, thoughts around that? Maybe Chuck, kick off with you.
Yeah, I think it brings us back to the point of trying to attract more of the larger players within the institutional space, and without proper regulation, without proper guidance, a roadmap for them to build their businesses and a roadmap for them to manage their risk, they're not going to come over. They need some kind of roadmap, some kind of guidance. So I think that obviously you shouldn't have regulation for regulation's sake. It has to be very thoughtful, very directed towards a specific goal. And when the institutions see that, I think you'll see them adopt the asset class more so across the board.
And Ilya, and what's your thoughts on the regulation side?
Well, honestly, I'm not the best person to ask about regulations, so I would be definitely passing it. I just actually going to come back to one idea only, which was kind of looming in my head. Coming back to previous conversation about technology for 1 second. 2 years ago, 3 years ago, it was REST and WebSockets, and there was no even fix. There was no even connectivity in an institutional way. 2 years ago, you can send an order, send cancellation order, send confirmation, get confirmation from exchange that order was canceled, and then get confirmation the order was filled. So you basically were totally dealing with this kind of stuff, and you had to build technology tools to prevent this from happening. It was a major overhead. At least today, not as happening as often. So if anything about regulations, there should be obviously ways to deal with exchanges and forcing them to be more disciplined and at least to a degree more kind of honest to how they operate. Because they could disconnect and connect and you never know about it. And so our clients are totally in the dark sometimes. And that's a challenge, of course.
And I think, I'm come to you, Brad, and also kind of thinking about, what else we need to do to make this new world an attractive place and for institutions and to help bring them in.
Well, I think certainly good regulation is good. Bad regulation is awful and deleterious. And I think that's be careful what you wish for to some extent. And so I think most of us in the room would probably like some clarity to exist. And I think that ultimately is one of the pieces that, is another piece that sort of prevents institutions were coming in, right? They form working groups, and it's a lawyer and a trader and someone from compliance and someone from like operations, and they go down this rabbit hole, and then they realize, oh crap, like we're not going to do this anytime soon. This is crazy, but they've like sort of, orange pilled themselves and they all leave and go do crypto stuff. And so we've seen that happen a number of times, and just one of the big things is what is the regulatory clarity that needs to exist? And so it's a hard problem to solve, but it's one like I'm encouraged to see, the bill that came out on Tuesday and, SEC, Congress specifically kind of working towards, clarity, understanding, the executive order. I'm hopeful that we arrive at a place that is thoughtful and not the bit license.
Okay, thank you. I mean, I know we're getting close to time, so maybe I'll finish off with give you each the chance to speak. And kind of thinking about the future, looking forwards, I mean, are we all going to be sitting in the metaverse trading NFTs on DEXs, or what? What does the future hold? Where are we going to be in 5 years, and maybe down the line, starting with you, Chuck?
We'll be here on a panel talking about what the future looks like in 5 years. No, I mean, what I'm super excited about is NFTs specifically, and not for sort of, I think, the normal reasons. NFTs are things that people have started to quote in a currency that is crypto native, right? And so people are talking about how much ETH they paid for a thing. And that is like the first time I can remember that happening. And like, it happened overnight, right? And so I don't even know what that necessarily means moving forward, but like that is a super cool sort of change for the average person in terms of talking what something is valued in native crypto.
Great, thanks. Ilya, the future.
I agree with you 100%, but to me, future is basically about intelligence. I hope the world will be more intelligent and the world will be more kind of smart, not in the order of smarter writing, but in the way how we deal with things and how we trust each other. That's kind of the biggest hope for me is actually coming to NFT, is the trust. Because will be the built-in measure of trust, which will be monetized potentially. And if you're a trustworthy partner, you probably will get rewards, which is different from non-trustworthy partner. That's what I hope future will bring us to, and that's definitely not today.
And Steve, with your tech hat on.
Well, just on an earlier point, I was secretly hoping that Ilya was going to propose a good enough regulation.
Yes.
That'd be
be great.
Yes.
That would be perfect.
So technology continues to grow. In the next 5 years, we're hoping that some of the regulation can put some structure around crypto trading. It becomes normalized, and I like Brad's thought about thinking in crypto as opposed to in U.S. dollars.
Yeah.
As a currency.
Cool. And finally, Chuck.
I think from a jaded outlook, probably going to be looking at a trading environment where instead of talking about milliseconds, we'll be talking about nanoseconds. We'll be talking about razor-thin margins, which is something that I'm glad I got away from for at least a short period of time from TradFi. But from a more positive outlook, I think we're really in the first inning of a 9-inning game when it comes to blockchain technology, and I think we're scratching the surface. And 5 years from now, the benefits of that are going to come to fruition, not just within crypto trading and everything like that, but I think throughout society. It'll be a much more embraced technology and something that's going to really show benefits and democratize the whole experience of this new world of finance.
Yeah, and I think everything we've talked about today, it is the future of financial markets globally. So very exciting. Thanks to my panel. Thanks for listening.